Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today we received the minutes from the Federal Reserve. So very quickly, I want to discuss what it means, what it is, and what we should consider as investors. So we got the Federal Reserve minutes came out today. Minutes are basically the notes from the meeting that they had earlier this month. I think it was May 3rd and 4th, if I remember correctly. And essentially, this is kind of what we've expected, which is why the market was up. When we get things that we expect, when the stock market sees things that it expects, it tends to go up. When it gets things it does not expect, the market tends to go down. But here's what we know. They are going to continue to raise interest rates, which we did know, but they're going to continue to raise rates by 0.5%, also known as 50 basis points. This is generally a good thing. I say generally because as someone who studies economics and went to school for all that, there's always an equal and opposite reaction. And the Federal Reserve does have to toe a very, very tight line between being too aggressive and stopping everybody from spending, which means you go into recession, and slowing enough people down and making enough people think twice before buying a whole bunch of stuff, because that is what causes inflation. You have way too many people bidding up the prices on homes and everything else out there, and that's what makes prices jump by 8%, which is what we've seen, a 40-year high in inflation. So the good news here is that the Federal Reserve is being more aggressive and telling everybody we are looking to stop inflation and bring it back down to about 2%, which is normal. That is their goal, is to get it around 2%. It's at 8. That's not cool, right? We all agree that that's not cool. Now, the other side of this for the stock market is, you know, and I know, we've been talking about it all year long. We've really been talking about it since December of last year, that because inflation is going up, because interest rates are going up, that the market is shifting. And if you haven't shifted your portfolio already, you definitely should have done that by now. But this means a few things. Number one, consumers are stronger than what they have been in the past. There's actually, I'll put this up here, a record of 68% of American households said that their savings could cover a $400 emergency in 2021. Previously, this stat was real bad, where you didn't have half of people who could cover just a $400 emergency. So that means that if we can bring down inflation, make things more affordable for everybody, that we probably wouldn't go into a recession, because the American consumer is a bit healthier, which is a good thing. So the threat of recession is still out there. That is still a possibility. Many still predict it this year. I don't think I'm on that train just yet. But in either case, they may be able to raise interest rates and everything could be fine. Now, the stock market is on the other side of this, because remember, the stock market is about what investors expect and what do companies expect. It's not necessarily reality and what is happening right now. So you have to remember to separate those two. The stock market can be down 20% and there not be a recession at all. That does happen. But because the stock market is down, the stock market is saying, look, I think there's going to be a recession in the very near future. So again, you got to separate those two things. And as an investor, I think you really want to pay attention here. I don't think this is an investable, newsworthy thing. Yes, the market was up today. That's great, because we need more good days, especially in 2022. But this is not going to make me feel any type of way. I'm keeping my emotions in check. I'm gonna mind my business and just stay the course. The thing here, though, is this. We know that the economy and the consumer is strong. They are making different decisions because of inflation. We saw this from Target, right? Target said that we've got stuff on back order, or we got stuff in the back that we cannot sell because y'all not buying it, which can be a good or a bad thing. Bad thing for Target, they lost 25% after they said that, right? But the other thing for the consumers, number one, that stuff has got to go on sale, which means prices are going to go down. Great for us, right? But the other thing is, we're in a spot where the market is overreacting to some things. Like, we got money, according to this stat and other things across the board, that we're not in an unhealthy place where everything is about to collapse and we don't have the money to cover it from a consumer perspective. So this tells me that there are a lot of companies out there for a good value. Perhaps if y'all want to, maybe we can do a top 5 or 10 stocks that I think have true value. Nvidia announced their earnings today. It was down. I think that is one that is of real value. Nike could be another one. Really, you can take 2 from the list that we did. I think on Monday. I think it was Monday. I don't know what day it is. I think today is Wednesday. So on Monday we did a video about 3 stocks that I think are good for the long term, but are down real bad right now. So this is that season. This is that season to find those mismatches where the market says this is a terrible company, But reality is it's actually not. And as interest rates continue to rise, a lot of the stuff that you have seen is going to continue. I don't see a reason for a lot of companies to be down 25, 30, 40% and automatically turn around in this year. And while that's not going to seem fun in this year, I still think it is value season, right? Find those companies that have value. If y'all want to, again, we can do a list on those. But as of today, this is not going to make me feel any type of way. As of today, this is not going to make me call and say this is the bottom and this is when the stock market starts to take off. I'm not doing none of that. Okay. And I think you should be very solid in understanding what you are investing in, because that is the biggest key here. We know what the environment is. Okay. Costs are rising. They're expected to fall. That is the case. And we know for the rest of this year, at a minimum, the Federal Reserve is going to continue raising rates. Your question and the thing that you should ask is, what do I own and what is the health of that business? Now, when I talked about Snapchat the other day, the health of their business ain't good. Okay, so you want to make sure that you have things that are good, that are healthy, and that are going to be in a position to grow, not in 2022, but really 2023, 2024, and perhaps even 2025. This right now, this moment is what's going to separate you from being quite wealthy in the next 2 to 3 years, and you just like, selling out of everything and not really making the right moves. Because in an environment like this, again, with the exception of energy, maybe Berkshire Hathaway and a few dots here and there, the majority of the market is down. Now, I'm telling you right now, the majority of the market is not trash. Okay, and that is the key here. There are some, maybe it's a Snapchat, maybe, and this is the most recent company we talked about, but the whole thing ain't bad. But however, the market is overreacting and overcorrecting. You know how good a company like, I don't know, a Microsoft is. One of my favorites is Microsoft. You know how good a company like maybe a Costco or even a Walmart, they're not going anywhere, right? But the stock market is overreacting to a lot of the news. Your job is to not overreact. Your job is to sort out and say, this is really bad. The rest of this is actually quite good, even though the market doesn't realize it yet. Okay. All right. That is it for me. Let me know what you think in the comments below. All right. Talk to you later.